Mhm. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq. We're going to discuss what Jay Powell actually means when he talks about tapering. So Phil, let's start there. What does it mean when the Fed says it's buying less bonds, not selling or raising rates? Should investors be concerned if the Fed buys less bonds?
Yeah, it's a really interesting question because for the last year or so, the Fed has been supporting the market by holding interest rates low and buying bonds, which actually also pushes the yields down. And they've got a huge balance sheet. They've been putting a lot of money into the system. At some point, it kind of has to go back to normal. The thing is, last time they did this, when it went back to normal or sort of headed that way, obviously rates go up, which means that there's a lot of pressure on price earnings multiples and valuations of stocks. And so the stock market actually had a pretty rough few months. And so people are quite worried about the taper and whether it's done too quickly, because it could have an impact as rates go up, stock valuations might come down.
What is the Fed looking at in terms of labor when making its policy decisions?
Yeah, so the Fed's kind of adjusted the way it used to work, and they're really letting inflation run up a little bit compared to what they used to. Instead of having a 2% like sort of top level that they're trying to target, they're trying to get the longer term average to 2% or a little above. So we're running pretty strong inflation now. That alone should probably give the Fed enough permission to do, I guess, normalization of rate policy on that perspective. But what else they want is more full employment, and not talking about the 5.4% unemployment rate, but across all of the different sectors of the economy that have been hurt by COVID. They want more full employment, and that's really what's holding them back, because we can see in the data, the manufacturing sector has had a lot of demand, a lot of re-employment, but the services sector, especially leisure and hospitality sector, is still a long way from being back to normal.
And another issue the Fed has to contend with is the impact of COVID variants to the recovery. Have you seen a slowdown in spending, or is the consumer bucking the trend here?
So that's a really interesting question. When we look at the retail sales data, it's sort of plateaued at a really high level, but adjusted for inflation, because prices have been going up, people have actually been buying a bit less. But really, I think what's interesting is the COVID aspect. And so we know we've got this fourth wave of COVID, and you're starting to see in some of the credit card spending data, people are booking less air flights, they're booking less hotels. So that leisure and hospitality sector that we really need to get going is actually starting to see people pulling back, just because people are getting fearful again of COVID.
And Phil, we spoke about this last week. While GDP is higher, stimulus is done, and unemployment benefits are largely ending, what does that mean to personal savings, and what are you seeing with inflation?
Yeah, so the reason that it's really important to get the services sector running is because it's actually a bigger component of the economy than the goods sector. So the fact that we've got inflation in goods doesn't really mean that much for the employment situation in the economy. We've had huge amounts of stimulus. It's triggered a lot of spending in that manufacturing and goods sector. But like you said, we haven't had a stimulus check since sort of January, February. When you look at the data, it looks like people have worked down their savings, and we're almost back to normal. And so what we're starting to see is people look like they're starting to spend a little bit less as well, just because they haven't got all that surplus income ready to spend. And so we're sort of torn between two factors. We've got strong inflation right now because of this sort of push in demand. Everybody's got all their stimulus checks and they've been spending, but at the same time, it looks like we might have some headwinds going forward, with less stimulus going forward, with the Fed sort of talking about getting its interest rates back to normal. There's a lot for the Fed to manage through in the next 6 months.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.